Good morning. Welcome to live market analysis with myself, Giles Cochran, as we get ready for the coming week. We have an action-packed week with the Reserve Bank of Australia meeting, we've got the Bank of England meeting, we also have the ECB meeting, as well as the ongoing risk that we have with the Russia-Ukraine tensions going on in the market and a general slowdown in US stocks on fears that the Federal Reserve is hiking interest rates too fast, too quickly, and by too great an extent. So I'm going to run through the key issues for us to be aware of. And also we're going to have a special focus on the Reserve Bank of Australia, because we do have, that meeting coming up overnight. And I'll show you how I'm going to use a few opportunities. I'll show how I'm going to use expectancy for trading that. So very warm welcome to you all. Without further ado, don't forget, as we look at different entries, exits, the whole idea of this webinar is from an educational perspective. It's not that I'm offering trading signals, it's all from an educational perspective. You see how I go about making my own personal trading decisions. Here is the typical areas we're looking at: natural gas, looking at the RBA meeting, what's going on with CAD, the dollar, copper, the strong gains we have potentially in February, as well as the Bank of England and what's supporting oil prices. So we've got an awful lot to be looking into. Before we get going, what I really want to do is just run through the big picture with everyone. Big picture stuff helps, and I'll be pointing out key opportunities as we move along. So without further ado, let's just jump over to my other screens and we will see what's going on. Right, so here we have US stocks across the top, European stocks across the bottom, with Chinese stocks in the middle at the bottom. So what are we seeing at the moment? Well, we're seeing US stocks and stocks generally sell off, because what the market's fearing is they're fearing that what's happened in the fourth quarter of 2018 is going to repeat itself. Now, what happened in the fourth quarter of 2018? Well, coming into the end of 2018, the Fed was on a hiking cycle. Just as growth was slowing, we saw equity markets sell off quite rapidly. Once again, we're seeing equity markets sell off just as the Fed is hiking, because markets are thinking that the Fed is hiking too quickly. So why is the Fed hiking? Because they're worried about inflation. Everyone's hearing about the problem of inflation. Now, if inflation becomes embedded into the economy, it becomes a big problem. So central bankers around the world don't want that to happen. So that's why there's been a strong pivot. Interest rates are being increased, just as most of the world is coming to grips with living with COVID-19 and the Omicron variant to a greater or lesser extent. So life is expected to get back to normal. Interest rates are being hiked. Some of the easy money policies that we've had are being reversed, and we're looking at the Federal Reserve now constantly tightening. Now that's incredible when you think just 6, 7, 8 months ago, last year, the Fed said no interest rate hikes to 2024. Fed fund futures now are pricing in 5 interest rate hikes this year. That is what's weighing on stocks. So that's why these retracements, most analysts saying that this is not a dip to buy, this is a rally to sell. So if this rallies higher, look for potential selling opportunities against these trend lines, right? As long as the current status quo remains. Now, one difference is China's 50 index. Now, China's 50 index has got pressure today because we had the mixed PMI data out of China overnight. There's quite a few mixed reports, and manufacturing, into contractionary territory. Let me just have a quick look at this. So I'm not telling you that's some of the slowing growth that's going on in the US as well. Just looking at that earlier, right? Now let's a quick look here. Let's look at the opening news. I'll just quickly show you that. Right, let's just look at the must read section. That will be easier. Yeah, here we go. And you can just see here in China, Yeah, manufacturing PMI 50.1, the services PMI 50.1, that was a miss. Composite was a miss, and the manufacturing PMI, yeah, was in contractionary territory below 50. So all of that's just been weighing on the Chinese stock market, and you can see that that's just been resulting in pressure to the downside, whereas most other equity future markets are seeing sort of more pressure to the upside. This remains a good area to buy China 50. Now the difference, the reason this is a buy is because China is looking at cutting interest rates. The rest of the world is looking at hiking. China's looking at cutting. Now China's falls in equity markets came last year as there was a slowdown in Chinese growth. But now the People's Bank of China is expecting to cut interest rates. They cut interest rates last week. They're expected to cut interest rates further and make conditions easier. So that means that this is a good support level. We would expect medium-term upside over the next sort of 6 months to a year. So it'd be reasonable to look for buying opportunities from market with stops just running underneath that 14,500 region. And should that level capitulate, it'd be reasonable to expect buys from 1,400 stops just running underneath 1,340 region. So remember, that's one opportunity that there is now. And it's obviously the weak PMI data. And the downside, the risk is this is China's zero COVID policy. So if they don't allow a little bit of living with COVID in China and they keep locking down cities on bigger outbreaks, if that maintains that stance from China, then that could result in further downside in China's equity market. So it's not without risk, but it is a couple of good support levels that I wanted to point out to you. VIX is sort of pushed very high last week on the Russian-Ukraine issues. They have faded. Doesn't look like there's an imminent invasion of Russia into Ukraine. So VIX moving lower. But basically, the bottom line is these recoveries in equity markets are looking like rallies to sell rather than dips to buy. So that's the received wisdom in the market at the moment. Just noticing natural gas prices, they've been surging higher. Russia supplies about 40% of Europe's natural gas. So what investors are worried about is that if Russia do invade Ukraine, then Europe's gas supply gets cut off. That means gas prices soar on huge demand for a limited supply. If Russia make an incursion into Ukraine, expect natural gas prices to spike higher. So that's one thing to keep an eye on. But you would need a trading squawk to use that. So you would have to have a trading squawk to get that news as it breaks. You need to get into the trade within like the first couple of minutes. Also, it wouldn't be a surprise to see that the spike fade, because even during the Cold War, Russia did not weaponize their natural gas supplies to Europe. And if you think about it, it doesn't make sense for Russia to weaponize their natural gas supply, because they might do it in a war and then everyone goes off and finds different natural gas supplies, don't they? And then you're literally cutting off the income of the country. So, in theory, Russia could weaponize their natural gas supply. In practice, just doesn't make sense, to lose your income by doing that. It's a big home goal. Copper prices lower. That's in line with China's A50 lower. Iron ore prices pushing a little bit lower as well today. That is on that slowdown in China's economy. Don't forget this little infograph, very helpful. That yes, most of the copper is produced in Chile, but most of it is processed. Nearly 50% is processed in China. Okay, so be aware of that in terms of copper. A nice little clean energy metals chart. I put that on my Twitter feed if you want to look at that in some more detail. Gold prices. Now, what's going on with gold at the moment is the real yields are surging, dollars surging, so that's why gold has sold off heavily. But if medium-term and growth and inflation expectations fall, we expect 10-year yields to fall. So we'd expect real yields to fall. And if the dollar fell, then there could see some upside in gold. So we're quite neutral on gold at the moment. But I'll show you what to look for. This is the relationship that you want to be looking at, is the relationship between real yields, the dollar, and gold. So you can see as real yields surge. Now, what are real yields? That's the US 10-year yield minus inflation expectations. Look at the Treasury Inflation Protection Security TIPS. minus the real yield. So if the real yield moves lower and the dollar moves lower, that will support gold. At the moment, you see dollars surging, real yields are surging, that pressures gold. Now, if you look here, do you see when they both drop? When real yields and the dollar drop together, gold surges. When they drop together, gold surges. When they drop together, gold surges, right? So when real yields and the dollar rise together, gold falls. When it rises together, gold falls. When it rises together, gold falls. So if we start to see, and the first place we'll see it is most likely in the 10-year yields. Now, in a yield curve, when you get like the short end of the curve, like the 2 years, 1 year, 6 months, that tends to be interest rate expectations. You see how that's been moving significantly higher. Now, the longer end of the yield curve, your 10-year yields, tend to be more sensitive to growth and inflation expectations. So we are expecting this to move lower because growth is expected to slow, inflation is expected to slow in the US. At the moment, we're still sort of quite supported, but we're not making above 1.90%. And the bond yield curve is moving flatter. Remember, if the bond yield curve goes into negative, that's often a big precursor to a recession. And it has correctly predicted a recession. So what we're looking for here is if 10-year yields start to drop, then that should drop the dollar, that should drop real yields, and that should lift gold. At the moment, we're neutral on gold because of the different things going on. Now, let's look through a few currencies. So Aussie, seeing a bit of love ahead of the RBA. We'll look at the RBA in a minute. The Japanese yen, remember Japanese yen, very sensitive to the 10-year yield moves. So if you look at 10-year yields, do you notice when 10-year yields rise, the yen weakens? When 10-year yields rise, the yen weakens. When 10-year yields fall, the yen strengthens. Okay, so if yields keep rising, you expect that to keep weakening the yen. Okay, that's a big pressure. So obviously with 10-year yields expected to fall, then that should strengthen the yen. Keep your eye on that. Canadian dollar, don't forget, Canada's biggest export is oil. So you can see here in the green chart, that's oil. Pink chart is CAD. So it's oil rises, CAD rises. As oil falls, CAD falls. That's the general relationship you need to be aware of. Oil's been supported, low inventory levels, Russian-Ukraine issues. The EIA revised up demand for oil. All that's been supported for oil, but growth and inflation should drag oil lower. So medium term, expecting oil to move lower. Near term, there's upside. So neutral on oil at the moment because there's mixed messages out there. But don't forget, CAD is highly sensitive to oil. And if we saw like oil tank lower, but expectations of an aggressive Fed still remain, dollar CAD upside makes a lot of sense. New Zealand US dollar does not make sense being so weak with the RBNZ expected to be so aggressive on hiking interest rates. RBNZ meet at the end of this month, 24th of Feb. That will be a very interesting one. Dollar just been surging higher on Fed rate hike expectations. Expect some correction. They do correct lower. Look at things like Aussie US dollar upside. Makes a lot of sense. Okay. There's so much more to say, but let's look at the majors quickly, and then we'll look at the risk events that we have coming. I've got to jump into a webinar straight at the end of this, so I'll want to make sure I cover everything. Now, the dollar, you see here, pushing higher, higher, higher. Why is the dollar been pushing higher? It's been pushing higher on expectations of the Fed being far more aggressive. And if you look here, you can see the Fed fund futures. Do you see them surging higher? Those Fed fund futures have been surging higher as they're now expecting 5 interest rate hikes from the Federal Reserve this year. Okay? So dollar's been surging higher on those Fed hike expectations. That's what's been driving the pair. So 97 is key. If we stay above that, that's bullish. If oil drops, but we stay above 97, look for more dollar CAD upside. If we move back below 97, we start to see some of that dollar correct. We still think that there's going to be a little dollar strength on all those Fed rate hike expectations. But if they move a bit lower, then you definitely want to look at upside in things like the Aussie US dollar, New Zealand US dollar, pound US dollar, euro US dollar. Okay, so dollars going to be a key focus. Right, now in that vein, let's now look at the calendar and to see what we've got coming up. We've got a lot of events. Cash rate coming out of Australia, huge. Now, at the last, do check out my blog, and I'll just put it here. I've got a little section here called Central Bank Watch. Just hit on my blog under the Central Bank Watch, and you can see that here, RBA sets up a bullish twist. I set this up in the 13th of January, okay? And I go through the reasons why I think the RBA is set to take a bullish twist. Those reasons are still valid, okay? They were valid then, they are valid now, okay? Exactly the same scenario. The RBA has met all the three criteria they needed to end their QE purchase program. So there's a high probability that we'll see Australian dollar strength out of the meeting. As a result, like, I am willing to go Aussie New Zealand dollar long from 1.0700, okay? Because I think, you know, if you had 8 times out of 10, I think that the RBA are going to turn more hawkish. I'll just run through the reasons. First of all, they said they'll depend what central banks are doing in December. Well, look at the Fed. They're expected to hike 5 times. Bank of England has hiked in December. The Bank of Canada put off hiking rates last week, but they kind of inferred that they would be hiking rates. And you know, there's enough central banks moving more hawkish. Secondly, the behaviour of the Australian bond market, that's been absolutely fine. Bond yields have been moving in the right direction, in line with other bond markets. They've been moving higher in expectations of higher interest rates. 3, employment and inflation data, all has been good. Employment, last unemployment data was like 13-year low. Jobs added was 60,000+, 40,000 plus of which were full-time. Inflation expectations, the headline figure is above the RBA's target. The trimmed and the median is over 50% of the middle of their 2 to 3% range, so it comes in like 2.6, 2.7% respectively. Fine. So everything's on target for the RBA to turn more hawkish. They have also got the biggest short position of all leveraged funds, of 80,000 contracts short on the Australian dollar. That looks very stretched. So I'm expecting that to unwind later tonight. Now, that should be, so I like Aussie New Zealand dollar upside from 1.0700 and potentially Aussie CAD, but remember CAD strength offsets some of that outlook. Stops, you want about a sort of 80-point stop just before the meeting and looking for about 80 to 100 points gain. Now, CAD, GDP, again, that will be eyed of in light of what the Bank of Canada was saying last week. So that's going to be important in terms of the general outlook for generally a more bullish outlook from the Bank of Canada. Dollar, looking carefully here, any signs of further slowdowns. If there's more signs of slowing down, then expect that to weigh on sentiment and expect that to weigh on equity markets. Key data points, employment for New Zealand. RBNZ meet on the 24th of February. They're expected to hike rates. They're expected to hike rates multiple times this year. If there's a big miss in the New Zealand data, then expect to see some New Zealand dollar downside because some question marks will be raised. If that's a good beat, then expect some New Zealand dollar to continue gaining into that RBNZ meeting. I would favour, if you suddenly saw US dollar weakness, New Zealand US dollar upside would make sense, or Euro New Zealand dollar shorts make sense. RBA Governor Lowe speaking, don't forget the governor can qualify something that was said in the RBA statement. So Governor Lowe's speech will be read in light of the rate statement. So always look to see, what does he say? Does he confirm? Does he double down? Does he contradict? That's the likely reaction to having the Aussie. OPEC, they're expected to increase production by 400,000 barrels per day. If they do increase in production, that's probably supportive for oil because it says, oh, OPEC aren't worried about rising production levels. The oil market must be tight, you see? So just watch out carefully what happens with OPEC. That will likely impact oil markets. As I said, we're neutral on oil at the moment. Medium term, there's reasons for oil to fall, but near term, there's drivers for them to rise. So a bit of a mixed market. ADP non-farm employment change, again, that will be important in terms of how the US are doing. Good employment is crucial for the US economy. And remember, the majority of the world's GDP comes from the US. The majority of that GDP is made up from wages. So US wages, US jobs, arguably, the most important data point in the economic calendar. There'll be reason for it to be in focus again because everyone wants to know how the US is doing. Governor Matt Glenn speaking again. You want to see what his view is post the BOC meeting last week. Then we have really Super Thursday, BOE and the ECB. Now, BOE, they're getting very worried about inflation. And they're worried about what's called the wage price spiral. And if you don't know what the wage price spiral is, basically it's this. If workers are charging more wages, companies have to charge more for their prices and their products. So that means higher wages leads to inflation, and higher inflation leads to higher wages, leads to higher inflation. That's the spiral. So expect the Bank of England to hike interest rates. You can see that they're expected to raise interest rates by 25 basis points. That's the expectations. And look at how aggressive are they. So if they hike and signal 3 or 4 more rate hikes for the pound to gain out of the meeting, if they are more in agreement, you know what I mean? If it's unanimous, that's more hawkish. And look what they say about the asset purchase facility vote, whether they reduce that asset purchases. Okay, so 875 expected. Any reduction in asset purchases, any significant bump higher, if they do a 50 basis points hike, that would be, quick spike higher in the pound and want to trade. ECB, they are expected to be on hold and maybe hike this year, maybe. So the biggest risk for both of these central banks is they do what the market's not expecting. So if the Bank of England is on hold, then that would be a big sell for the pound. So you expect euro pound upside. If the ECB turn more hawkish, then that would be a decent sell in the euro. So you look at euro US dollar, because at the moment the divergence between the Fed and the ECB is quite marked. So that's why we're seeing so much euro US dollar downside. I'll show you how to work that out. If you just look at the if you just look at the bond yield spread between the ECB and the Federal Reserve, so when you're looking at the bonds for euro, there isn't a euro bond, so you just look at the German bond yield spread, and then you look at the US, so that's the bond yield spread, okay? And that gives you an indication of the differing outlook between the two countries. Now, let's get rid of okay. Let me just put this on properly. Right, that's better. Okay, so you can see here, at the moment, the bond yield spread is moving a little bit higher. Now that, typically, you see how price tracks the bond yield spread? So if the ECB are more hawkish than the market's expecting, then you really would expect this euro-US dollar pair to move higher, okay? At the moment, the fact that the ECB is expecting more dovish than the Fed, that's where the bond yield spread has been moving low. You see on the charts moving from lower And recently, since the start of January, see how it keeps dropping lower, and that's been dragging the euro-US dollar down. We are seeing a bit of an uptick today. So as long as the yield spread keeps moving higher, that does give upside for the euro-US dollar. It's definitely one to be keeping your eye on heading into the ECB on Thursday. And the difficulty the ECB are having is they've kind of like morphed their pet purchase program, which is due to end in March, into their asset purchase program, which they see tapering down to 20 billion per month by, like, I think September this year. If they taper that further or end it sooner, or they start hinting at worries about inflation or hinting about interest rate hikes, then there is potential for the euro to really surge. So look at the euro carefully on Thursday, and the pound. Last couple of meetings, the Bank of England has really surprised markets and confused them. So that gives good opportunity for us as traders. And then we've got NFP. We have NFP coming. Sorry, just having a look here at the Canadian dollar. Again, that will be important for, we've already discussed with the Bank of Canada, and labour data, very important for the US. Okay, just keep your eye on that. Okay, just keep your eye on that for the reasons outlined. Okay, folks, that is what to look for. Good opportunity ahead. I can't stress enough the Aussie dollar. Right, that's really like the best opportunity of the week, is what could be happening with the Aussie dollar. And, you know, put a gun to my head, it looks like the Australian dollar could be gaining out of the meeting. So I position to go long from 1.0700. So if I move back on the Aussie New Zealand dollar chart back into this region, I will be going long into the meeting, and I'm happy to run the risk of the event. Now, that doesn't mean the trade will work, you understand? Of course not. But, you know, we are, you know, any moves back lower there to 1.0700 prior to the meeting, I'm expecting that's nice to go long into the meeting. Okay, folks, I'm going to rush off to another webinar. Absolutely a pleasure. I will be back here on Wednesday, and we'll get really into some more detail about trading the Bank of England meeting. So don't forget that we will be returning for that on Wednesday, 12:30 p.m. Apologies, I have to rush off, but I'm going straight into another webinar. Thank you all very much, and I look forward to seeing you on Wednesday. Take care, everyone now. Goodbye.